Hey guys, I'm just going to film this short video about Technical Review 17.3 for our financial reporting class. The teacher did go through this question, but I'm just going to kind of go through it again in a very simple way to help me study for my midterm, and if it helps you, I'm happy to hear that. So with that said, we're given some information about a company called Petrelli Limited. Um, so for the first 3 years they were in business, they made money. They suffered a fairly significant loss in 2008, and they suffered a further loss in 2009. We're also given the tax rates for each year, and we can sort of see the tax rates progressively increasing. And there are 4 parts to this question. In the first part, we're asked how much refund can Petrelli claim in 2008? So we know they can carry this $3.5 million loss back up to 3 years. And we can also see that in these 3 years, they never made more than $1 million. So just logically, we can tell that they have a sufficient loss here to cover their entire profit over the 3 years. So to know how much we can get back, we need to know how much we paid. So our first step here is to calculate our income tax payable. How much income tax did they pay in those 3 years when they made money? So we're going to press equals, and we'll multiply the taxable income by the tax rate and drag it along, and we'll see that this is how much money Petrelli made. And we can just sum that up down here, and that will give us our answer. We can press sum, select these cells, close our bracket, and we can see we made $695,800. Well, not made, that's how much we'll be able to get back because that's how much we paid out in taxes. Next, we need to know what's the amount of the loss carry forward. How much of this amount, how much of this $3 million how much of this $3.5 million loss is left over once we've covered all of these gains? Well, first we can total the amount of the gains. We'll press sum, we'll select these cells, and we'll see that in those 3 years we made $2.5 million. Then we went on to lose the $3.5 million. And 3.5 million minus 2.5 million is 1 million. So we have a $1 million loss left over. That's how much we're going to carry forward, and we can carry that forward up to 20 years to cover any future losses. Next, we're going to do our journal entries. First, we have to do the journal entry assuming that the loss carry forward is probable. So what that means is we want to be optimistic here. We want to believe that our company is going to make money in the future. And in a sense, even though we still lost money this year, to go from a $3.5 million loss to only a $100,000 loss is not bad. We could be on the road to recovery, so we're coming into 2008 and 2009 assuming that our business is going to keep going. So in that case, we're going to carry that loss forward in the hopes of covering gains in the future. So the first step here is we're going to get our income tax receivable back. That's an asset, and that's also going to be a debit. Next, we have to defer this. We don't carry the whole $1 million forward. We carry forward $1 million times the tax rate, in this case 32%. So we can press equals 1 million times 32. We can see that we're going to carry forward $320,000. And our income tax expense recovery is a plug. It's just our debits summed up. So next we need to move on to 2009, where we had an $100,000 loss. So first off, we need to fill in our T account for our deferred income tax loss carry forward. So on December 31st of 2008, we had $320,000 in this account. And our total loss as of 2008, the amount of loss we had to carry forward was $1 million. Our total loss as of 2009 is a little bit more than that because we lost another $100,000. So our total loss as of 2009 is equal to $1 million plus the new loss, in this case $100,000. So the total loss we're carrying forward as of 2009 is 1.1 million. So think of this as the 31st of December, year 2. So the amount here that's in this account now is going to be equal to 1.1 million times 33%, or 363,000. So let's just call this the middle of the year. How much did this account go up? What's the adjustment we need to make to this account to get to the correct amount of 363,000? Well, it's easy to determine that. We can use just simple subtraction. We're going to subtract 320,000 from 363,000. And we're going to get 43,000. And that's our adjustment, and we can just enter that into our 2009 entry. That's how much the deferred tax asset will go up. And this is the counterbalancing credit account. So next, I'll just bold this so it looks good. Next, we're asked to make the journal entry assuming that the loss carry forward usage is not probable. So in this case, we're a little more pessimistic. We don't know if our company will ever make money again. So we need to take that into account. We need to be realistic about our future in this company. So in that case, we're only going to get our income tax receivable back. We're not going to record the loss carry forward because we have no realistic expectation of ever using it. And the same will be true of 2009. We're not going to make a journal entry in 2009 for this because there's no taxes to recover. And there's no loss to, well, there is a loss, but we're not going to carry it forward because we're worried we're going to go out of business. So that's everything. That's all the journal entries, and that's this whole question.